today we're going to discuss the trading multiples used in investment banks. The objective of this model is to value a private company using the trading multiples of listed peers. So in most investment banks, such models are automated. So all you need to do is insert here the ticker. The ticker is a kind of code that enables the financial databases to understand which company we are talking about. So it's a kind of unique identifier. The model is automated. All you need to do is insert the ticker and everything will run. So it depends on how you would like to use it. If it's for some meeting which is not important, a relatively unimportant pitch book, you can just put the ticker here and you obtain the multiples directly. But for other instances, building a valuation report or for some important assignments, you would need to do everything manually in order to improve accuracy. So today we're going to focus on this second case in which we're going to build everything manually. So the first thing you would need to do is to calculate the market cap. The market capitalization or market value is defined as the share price multiplied by the number of shares. So the share price, normally you would get it automatically through the formula once you have inserted the ticker. The formula is linked to Bloomberg or FactSet or other financial data providers. If not, there are plenty of free databases out there, such as Google Finance, in which you would find such information. The second item you would need is the number of shares. Here, this is an information which is released by most listed companies on their websites under the investor relations section. Normally, for those who have the best degrees of disclosure, you would have such information monthly. Make sure you take the latest information or the latest number disclosed. If not, if you don't find it directly on the company's website, you should be able to find it in the company reports. For the example I took, I was able to find the information in the 10K. In the US, for US companies, you use the 10K, which is the most extensive source of information. For European companies, you should use the reference documents. So in this company's 10K, in the first page, I was able to find this information. They just disclose directly the number of shares, and they say that this company has 2.9 billion shares. Once you have those two information, you can calculate the market cap, and that was the first step. The second step is to calculate the enterprise value. In order to calculate the enterprise value or EV, you would need to fill in the bridge items. The first bridge item is the net financial debt, which is usually defined as interest-bearing debt minus cash and cash equivalents. My advice here is that you take the number which is directly reported by the company. Because in some industries or some companies have a slightly different definition of net debt, and you want to make sure that you take the, the most accurate number possible. So if the company discloses the number in its report directly, you take it. If not, you would need to calculate it by yourself from the balance sheet. Make sure you use the consolidated balance sheet in order to capture all the subsidiaries. So here I was able to find in a note, although the company does not disclose an exact number for its net debt, it disclosed the definition of its net debt. So it's defined as short-term borrowings, long-term debt within 1 year, finance lease obligations within 1 year, long-term debt and long-term financial lease obligations, which is fairly close to the standard definition. So for all the debt items, you could find them in the balance sheet under the liabilities and equity. So I highlighted here all those elements that are mentioned in the definition, whether long-term or short-term financial debt, from which you would need to subtract cash and cash equivalents, which you would find it under the current assets. Then the second item of the bridge is the pensions and benefits. Here we would need to pause a little bit because there are two types of pension schemes. The first scheme is called the defined contribution plan. Under such scheme, the company would make a contribution at the end of each period directly to an asset manager or a pension fund, and it won't bear any liability towards its employees since it would pay an expense every year to this pension fund, and the pension fund would bear the liability towards the employees. The second kind of scheme is called the defined benefits. Under such scheme, the company would pay the employees once they retire. And here, under such scheme, the company would need to record the liability in its balance sheet since it would have a liability towards its employees. So where do you find the information? Usually, you find them in the notes that accompany the balance sheet. So here in the notes, I found that the company that I took for this example has the two kinds of schemes. The first one is the defined contribution plans. So the company pays every year a certain amount recorded here to pension funds or asset managers, and as such, those pension funds would bear the liability towards the employees, and the company would not record any liability in the balance sheet, and as such we would not need to record any liability in the bridge. And it has also the second scheme. So here it says that it has some defined benefit pension plans, which are underfunded by $140 million. And here the notion of underfunded is very important because what happens in reality is that companies set aside a certain amount of funds in order to meet their obligations when employees retire. So what is interesting for us is just to take the underfunded part, which is the difference between the liability and the amount of money that has been put aside. So here we would record those 140 million here as a liability, and we would need to multiply them by 1 minus tax rates, because in most countries those expenses would be tax deductible the day that they would be paid to employees. So of course that would depend on the tax framework of each country, but in most countries they are tax deductible. Then the other bridge items are minority interest and associates. So we add here those items only for to compare apple to apples and to have a coherent ratio. This topic is extensively discussed in the Wannabe Bankers blog, so I encourage you to go there if you want to learn more about that. But very quickly, in a nutshell, for instance, if a parent company owns 80% of the subsidiary, due to the accounting rules, it would consolidate its EBITDA at 100%. So in order to have a coherent ratio, we would need to add the 20% that are owned by the minority interests in the EV as well. So the same logic works for associates. So here in this video, the purpose is to show you where to find the information, but for the logic of these adjustments is explained extensively in the blog. So the minority interests are also called non-controlling interests. You would find them here in the liabilities and equity section of the balance sheet. So here for this company, it's $7 billion. So I put 7 billion here. And then we would need to subtract the associates. We would find them here under the long-term assets. The exact denomination is investment in associates or investment in associated companies. So there is no formal denomination, but it should be something like this. And then the last bridge item is something we just call other, just to adjust for the specificities of some industries. For instance, if you are trying to calculate trading multiples of a utility, which sells power, and it owns power plants, so at the end of the lifespan of the power plant, such power plant would need to be decommissioned, which would result in a cash outflow. That's why we would add the decommissioning debt as a debt-like item here. So yeah, that's it. So just this order is just to take into account the specificities of some industries that would have some liabilities that are specific. But in most industries, it's just zero that you would need to put here. So once you have calculated all the bridge items, you sum the market cap and the bridge items and you obtain the EV. The next part of the model is the financials of the listed peer. So here normally you have a formula linked to Bloomberg or FactSet or other financial database providers that would give you directly the financial forecasts of the peer. This is linked to the ticker, the identifier. And then once you have here, you have the EV and the market cap, you would be able to calculate the multiples. For instance, the sales multiple is the EV divided by sales. So this company trades at 0.8 times its sales. It also trades at 12.3 times its EBITDA, and it trades at 25 times its EPS. So really that's it. Here you'll have the trading multiples. You replicate what we have done for the other peers. And once you have done all this for the set of peers, you would have this trading summary here. Really, it's a summary of all the multiples we have calculated for all the companies. And what's really interesting here is to take a look at the average and the median. And in order to value the private company that you are trying initially to value, just take the average or the median, you apply it to the financials of this private company, and you would get the EV of the company you are trying to value. So that's it. I hope that it provides you with a good overview of the trading multiples models. If you have any questions, just contact me through the Wannabe Bankers contact form. And see you in the next video.